And thank you very much for those of you who have braved one of Canberra's lovely cold winter nights to come in and join us. And for those of you online, thank you so much for sharing your evening with us. Much appreciated, and it's great to have you on board too. So everybody make sure you've got a drink. Financial planning, investments and stuff is sometimes a bit dry, but tonight is actually going to be fantastic, but a drink will keep you warm anyway. And please do help yourself to nibbles. That'll be good. I'm going to introduce you to Bob Chen, our financial planner. For those of you who haven't met me yet, I'm Melissa Healy, one of the directors here of both the accounting and financial planning team. And Jason Griffiths, one of my other co-directors, will be joining us shortly. I think he's just finishing up in a meeting next door. So he'll sneak in the back later on as well. But so thank you very much for coming. I'm going to hand you over to Bob and he'll introduce you to what's happening tonight. Okay.
Yeah. First of all, welcome for the evening of fun. And I know it's Tuesday night. You probably got it. So thank you for taking the time to come in here. A bit of housekeeping. So for those who haven't been to the office before, outside the door, left-hand side is to the ladies, right-hand to the male toilets. Drinks for those who want to have plenty of water and you want something a bit more punchy. And I think there's a whole bucket for wine and beer. So be my guest and have that. Ethical investment has been something in the market for a very long time. And I guess my interest in this area started about 10 years ago. At the time, ethical investment was a sort of a trade-off. So if you invest ethically, you have to prepare to lose a bit of money. And that kind of changed a bit now. And partly is because I believe companies thinking ethically, they're thinking long-term. Right? So they're thinking about the impact. They're likely to have a purpose. They're likely to think about impact to the environment, to the social, and also its workers. So the performance kind of will converge now. So there's a really good return by thinking ethically. So it's not just a value-based investment proposition, become a performance proposition as well. We're very pleased to have Australian ethical investment company here today. They have been in the market for 30 years, 35 years. In fact, Tim just told me, 20 years ago, they were working out of Dana Primary School. Is that correct? Yeah. So there's a history with Canberra as well. Our relationship with the fund manager is free of conflicts. So we don't accept any benefits, and we are solely here to bring investment specialists to inform and educate. So we're not talking about product here. We are talking about philosophy. We're talking about approach can diversify your investment. This event will be focused only on philosophy, investment solutions, and not on products at all. Australian Ethical Super Fund, we have 3 speakers today. Tim is the portfolio manager, specializing in fixed interest. Tim will talk about the market updates, economic updates. I think for those who haven't watched the news, I can tell you that RBI decided to put up 0.5% today, which is quite dramatic. It's the first time in 22 years we see a 50 basis point raise. We also going to have the pleasure to have Dr. Stuart Palmer, the head of ethical investment, to talk to us about climate change. And he's particularly going to talk about the materials, hydrogens, and gas. And it's quite surprising, I think not long ago, I've been told by some federal government people decided the energy price can go up tenfold. And I thought that's impossible. And I think recently we're already seeing they've gone up 300%. So we are dealing with a very challenging environment currently. We also going to have a Quyen, and she's going to talk about the ethical investment concept. So let's put our hands together, give Australian Ethical Fund a
No. Getting our PowerPoint slides right.
Okay, so what I was wanting to do was give you a quick update. Sorry, my name is Tim Kelly, Fixed Income Portfolio Manager for Australian Ethical. What that means is that I'm managing our fixed income portfolios. So we have a short duration fund and a long duration fund. I'm looking at fixed income constantly. And that can make some of the material a little bit dry, but please fire away with any questions that you might have while I'm speaking. Now, some of you may have heard that what's happening for the year is that central banks have turned a little hawkish. And so what we're looking at is interest rates have moved. This is the Australian dollar yield curve. And what we've got is the yellow line is where we were at the start of this year. And the green line is where we were yesterday. Of course, as Bob noted, we've had the RBA have moved a little more than expected this afternoon, and that has shifted a little higher again, particularly here at this front end. But what we've seen happen this year is a significant event where the yield curve has shifted higher. We've had rates increasing at every single point across the curve. This next,
Sorry, I'll get that fixed.
no worries. What that is reflecting the expectation that interest rates are going to be moving higher. We are, of course, coming out of a period where during the pandemic, central banks around the world have decreased interest rates to near zero. But what we're seeing now is the expectation that, first of all, that rates were going to normalise. But then in March, the tone of things has changed. So at the start of the year in January and February, we had the US inflation printing at 7%, Australian inflation printed in the target band, and the markets were pricing as though we were going to start normalising rates. So rates were going to come back to where they were before the pandemic. So the cash rate just before the pandemic began at the end of 2019 was 0.75%. The expectation was that we were going to see central banks hike a little bit, but not a lot. That all changed in March, and we saw rates start to accelerate higher. And the reason for that was that inflation began printing higher again. We saw 8.5%. The Russian invasion of Ukraine triggered a flight to safety at first, where we saw yields coming down a little bit at the end of February. But what happened next was that commodity prices started to run away, and that stoked global inflation fears. We were already in a situation where supply chain stress had seen inflation pressures coming through, which is why we're printing in these 7s and 8s. But this started to stoke the fear that this inflation spike wasn't going to be temporary and it was going to continue to build. That changed the tone for central banks. Fed Chair Powell signalled that he was willing to move interest rates to beyond a normal setting. To beyond a neutral setting. So that's actually moved interest rates to a point where we're not trying to keep the economy going. We're trying explicitly to tap the brakes and slow things down in order to put pressure down on inflation. Now that continued right through March and April, peaking at the end of April when we see the Aussie inflation print come through. And then in May, markets have taken a bit of a reality check. What happened at the start of May was we had meetings from both the Fed and from the RBA, where the Fed hiked 50 basis points. They said that there was more to come, but the Fed chair was hosing down the market expectation that had begun to be priced in, that there would be 75 basis point hikes to come at the meetings through 2022. Similarly, the RBA governor said, we're hiking 25 basis points. And then he said that 25 basis points will be the standard move. And that, until today, had set the expectation that what we would be seeing was a series of rate hikes from the RBA through 22 of 25 basis points. The RBA itself, where we started the year was that they were expecting inflation would be a short-term phenomenon. The trimmed mean was expected to peak in the middle of 2022 and then return to inside the target band. What's happened now is that inflation has become persistent. They are now expecting inflation trimmed mean will peak at 4.5%, and that was in the Statement of Monetary Policy in May. In today's statement, they have explicitly said that inflation is going to be higher again than that expectation. What's driving that increase is this time it is food prices because a result of the floods, electricity and gas prices, and the petrol price. is continuing to put pressure on inflation that they feel that they needed to respond to. So inflation is going to remain elevated through the rest of this year and remain above the target band through next year as well. Unemployment has actually surprised them on the downside. It was at 4.2% at the start of the year. It's now 3.9% and expected to go as low as 3.6%. Interest rate hikes at the start of this year, the RBA was very reluctant to concede that they would be hiking rates at all in 2022, having said to the market that they didn't think rates would need to rise until 2024 last year. That tone has had to change. We're no longer talking about patience before hiking, where they were waiting for wages growth to show that inflation would be sustainably above target. Instead, patience is gone, and the board's committed to do what is necessary to get inflation back to the target band. And this will require a further lift in interest rates. That statement was introduced last month, and that statement was repeated today after hiking by 50 basis points, which, as Bob pointed out, was the largest hike that they've done in over 2 decades. Quantitative easing was still going at the start of this year, where they were buying bonds. Yield curve control, where they were guiding that the rate would be held for the 1 to 3 year bonds. That was abandoned last year. Quantitative easing left at the February meeting, and we're into a stage of quantitative tightening now. What that means, though, is that the RBA is going to passively let their balance sheet run off. They're not going to actively be selling bonds into the market, but they're going to allow bonds to mature out. And the main impact from quantitative tightening is actually the end of the term funding facility. The very, very cheap funding that they were providing to the banking sector is actually going to unwind in 23 and 24. And that's forcing the banks to come back into the market now. So for the RBA in 22, we have a disconnect at the moment. Markets versus economists. Yields have shifted with that yield curve that I was showing, and with the increase in the 10-year bond rate. There are only 7 meetings left this year. It's now 6 after today. And the market was pricing as though we were going to reach 2.77% by the December meeting. That number was yesterday's number. This morning, that number was 2.85%. After the RBA meeting today, that number is now 3.05%. That implies 2.5% or 2.6% worth of hikes now, where economists are much more sanguine. They're expecting a less aggressive rate hiking cycle from the RBA. They think the RBA can only move so far before people start to feel pain. And so they're expecting that we would get to 1.75% by the end of 2022, or 1.5% of hikes. What we've actually seen this afternoon, I've seen at least one bank has revised that 1.75 to a 2% number, but it's only a small concession higher. It still doesn't agree that the market is calling this correctly and think that the market has pushed fixed income down too much so far. So what's next? My favorite line from the Westbury, what's next? What we have is 2 things happening at the moment. We've had a change of government, but the election 2022, it was won on a small target strategy. There's little substantive policy change coming because as a result of that change of government. Unlike 2019, when there was a very large amount of policy that the Labor Party was running with, this time they were running quite small. The majority in the lower house, that's going to make policy a little bit more predictable. There's going to be less horse trading that needs to be done in order for Labor to move through their agenda. Inflation is posing cost of living impacts on households. There's an obvious challenge for the government on how to deal with that. The short-term nature of the fuel excise changes that the Morrison government introduced, and whether or not they will continue to actually provide that assistance to households. The minimum wage determination also, we've already seen the government have said to the Fair Work Commission that they think that the lowest paid workers in society shouldn't be going backwards. And so that implies that the minimum wage will possibly be tried. The Fair Work Commission should move the minimum wage up in line with inflation, which so far has been 5%, but some are starting to suggest could be as high as 6 or 7 later this year. The fiscal impulse, though, from the government is fading out as pandemic era cash supports are slowly being removed or have stopped. And the less obvious challenge is, do stage 3 tax cuts still get cancelled in the name of fiscal responsibility? The Labor Party campaign say they wouldn't cancel the stage 3 tax cuts. So I think it would be politically painful for them to do that. But if the economic circumstances roll out such that it's needed, I don't think that they would hesitate. Are we headed for a recession? Central banks are very early in their hiking cycle. We've only just started to see those hikes starting to come through, but the pricing is all front-ended. There's the potential that they go too hard, too fast, and trigger a recession. But so far, the yield curve is not saying that is definitely coming. The US 210 spread, so the difference between 2-year bonds and 10-year bonds is 30 basis points. It inverted briefly in March, but didn't stay there. The Aussie 210 spread is a good 80 basis points. Equities, though, have already wobbled as a result of the rates starting to rise. We've seen tech and growth bear the brunt of that, with the NASDAQ down 23% year-to-date. In late May, we've seen consumer discretionary companies in the US show some weakness after profit warnings, where they're starting to see inflation bite on margins. And so we saw a little bit of that reflected in the Aussie market in May, but that has since been wound out. And so that is it for my quick macro run through of where we are at the moment. The RBA decision today was a surprise to see them move by 50 bips. I probably would have expected 25. The survey suggested that it would be between 25 and 40 basis points. So seeing 50 was quite a large number, but that rationale was very much around there are new domestic factors now that are starting to impact on inflation, and that is the electricity price, gas prices, and food impacts from the floods. Whether the RBA continue to move by 50 basis points, I think is still an open question. The market is definitely priced for that to occur, but I think that we will run into trouble quite quickly with people who have borrowed much larger mortgages than they have in the last hike, before the last hiking cycle. So I think that we have some caution ahead. If I was to try and leave you with something that was a little more optimistic than that macro outlook, one of the encouraging things when you work in fixed income is when you get to see the potential for ethical investment opportunities in fixed income. And increasingly, we're seeing sustainable bonds and green bonds being issued by issuers. And so the green bonds that we've been able to participate in have been able to channel money towards renewable energy, or to assist companies in nailing their colours to the mast with what kind of sustainability initiatives they are going through. And they are saying, if we can achieve these particular goals, then we get to call this a sustainability bond. There's triggers in those kind of bonds if they fail, where the coupon will step up, but there's not a reward in there for them for actually achieving those goals. So those are the kind of bonds that we've been including in a fixed income portfolio. But otherwise, I'll hand over now, Quyen or Stuart.
Yes, so that's me. So thank you. So to Tim's point around green bonds, I mean, we've seen we need to kind of have the capital channel into certain funding to be able to fund infrastructures. So it's positive that we're seeing that, but we're definitely behind the US with the Joe Biden's administration now really fueling that up and aligning himself with the climate. So hopefully, we follow that path soon. But what I wanted to talk about today is just the concept of what is ethical investing. So ethical investing at its pure form is about channeling capital and directing that towards towards areas that you want to make a positive change, and holding back capital where you don't want to cause necessary harm. So that's essentially taking a stance that's aligning with your values. It means that refusing to invest in certain industries and proactively directing money in investments that provide a positive social outcome. So for example, if you're a vegan, you might want to ensure that you invest in sectors and areas that don't have animals. So that's aligning with your values. So ethical investing has a positive impact on the world and also aims to make profit. It means that you get financial returns without sacrificing your values. So typical ethical investments focus on areas like climate, animal testing, workers' rights, tobacco, and the weapons industry. So that's typically been the focus in the past. So how can ethical investing change the world? So while many organisations are really moving towards sustainable, ethical, and new regulations coming in, requesting for reporting standards of companies to align themselves with climate, we were feeling that the direction can be accelerated with more capital and resources channeling into that area. So ethical investing rewards ethical companies and punishes unethical companies by withholding capital. This is called the power of capital allocation. Okay, sorry, we just skipped the slide a little bit. So for us, it's really about money talks, as they say, and by not investing effectively removes companies' social license to operate. So if enough people feel the same way, then the company is less valuable and their share price could fall. So in theory, this could lead to corporate policy change, and this is what we're kind of seeing, the movement. As many people invest ethically, trust in this space increases and investment strategy gets built up. And this is likely a knock-on effect, so you'll see more products coming into the market. So essentially, it's creating a paradigm shift, which is turning to creating more sustainable companies out there. So long-term, this can be a catalyst for significant social change, more people investing only in companies that act responsibly and avoid bad apples. So a practical example of this is capital allocation, such as climate, banks, reinsurance companies, and making sure that they align themselves with the Paris Agreement. So what are the benefits of ethical investing? So there are numerous reasons, but for us, it's about, Bob mentioned earlier, historically, it's about having to, you want to invest in line with your values, you have to sacrifice returns, but over time, as more money is being channeling into this area, and we're seeing that these companies, are more socially responsible. There's no corporate governance issues. There's no fines. So essentially, it makes sense to invest this way. So that's essentially where you're seeing the competitive return. So long term, from our perspective, the funds have really stacked up on performance. And then the other part is positive impacts for people and animals. So for us, it's about investing to make money, to generate returns, but also we care about the planet, the people and animals. So that's essentially giving you the power and channeling your money to be able to create change. And the third part is de-risking your portfolio. So companies that embrace responsible investing, I guess I mentioned earlier, ultimately translate to better performance because they have higher ESG standards and functions and quality business practices. So there shouldn't be any less exposure to tailwind risks, losing unforeseen results. So, we've got that interesting part about what's happening with AGL at the moment, with the demerger and all that. So that's quite an interesting concept that's happening. And, with Michael Cannon-Brooks coming on board and, trying to create change. And, and then a few number of the boards have resigned. So that's quite interesting. That's definitely a movement. And then the other benefit is, sleeping well at night, knowing that, you're investing in an area that's creating social change, helping channel to fight combat climate, and also, getting positive returns and investing for, a better future. So the next part we'll look at is, kind of the not so great area. So, I don't want to talk about all the good stuff about ethical investing. There's also the other part, where you probably need to have a look at, potentially the myth is that it's limiting your options because this space, there's not many options, investment options, and it's also the greenwashing part of it as well. So, a lot of companies can say, labeling and have gear up their marketing team, have great taglines to talk about, but really digging deep to understand, are these companies are saying what they're doing? Are they engaging with, the government? Are these investments engaging with the government to shift the agenda? What are they doing at the AGM? The shareholder resolution, the voting, is all done so there's a lot of issues around greenwashing, and the regulatory is now coming in and putting a spotlight under that. So that's why it's important to also look through that lens as well. So from our perspective, we invest in a way that we want to generate returns and not sacrifice returns, but we want to also create a better future and invest for real world outcomes. So to give you a bit of context, we are unique in the sense that our investment, so our ethical screening is separate to our investment approach. So what that essentially means is that we have a team of ethics team that's resourced up, and they look through all the universe of stocks to make sure that it meets our charter, which is our guiding principle that has developed over 35 years ago, which guides us to positive companies, and then we weigh out the negative companies, and then that goes into the investable universe, and that's where the portfolio managers have a look at the companies based on the fundamental merits of that company, and then that goes into the investment portfolio. So if you kind of have the same approach as one team, sometimes the portfolio manager can fall in love with the stock, and then the financial performance does stack up, and then they forego the governance side of because it's a minor, and they're trying to make profit essentially, or generate returns out of the portfolio. So for us, it's about having a rigorous process, remaining true to label, and having that process where even though it's a separate, the team works separately, but they share information, so it's peer to peer, so they collaborate in certain areas as well. So just lastly, to leave off with you, just to say, where do you sort of start? It's about sitting down and having a think about, what are the real world changes that you want to contribute and you actually can with your money. It's about channeling capital. So having, sit down, having it as an exercise with your family, and then essentially, do you want to, channel capital to support the transition, and invest in renewables or the transition companies, or, if you want to invest in a company that doesn't harm animals unnecessarily. So essentially that's, things that you can kind of jot down, then have a chat to Bob or Melissa around what other solutions that's available for you to be able to invest in line with your values. So with that, I'll hand over to Dr. Stuart Palmer to talk about investing in times of climate change.
Thank you, Quyen. I hope everyone can hear me online and in the room. Yes?
Yes.
Great. And yeah, Quyen, that's fantastic. If you can, I assume you'll drive the slides for me. Anyway, thank you very much for having me. I'm going to be talking about ethical investing in climate change. So a huge range of issues that ethical investors think about in terms of impacts on people, animals, and the environment. Climate's just one of them, but it probably is the biggest one at the moment. And just starting with those elements of responsible investing, ethical investing, there's lots of labels in this space, ESG, sustainable investing, impact investing. I think it's interesting to try and just break it down. What are the core elements of any form of ethical or responsible investing? Firstly, there is that targeting capital element in the context of climate change. We're often thinking about how we avoid funding the expansion of fossil fuels, which is contributing to the unacceptable warming, how we're ramping up capital towards activities, sectors like renewable energy, low carbon building materials, low carbon sources of nutrition, for example. And that second element, engagement and advocacy, I think, the best example we have at the moment, Quyen, you're right, is AGL, activism from an individual, high net worth in terms of Mike Cannon-Brookes, but also key there were some of the institutional investors engaging with AGL on the proposed demerger with deep concerns about the plan and the alignment with Paris Agreement climate goals, which ultimately led to the withdrawal of that demerger proposal and a significant change in the leadership of that company. And the third element is really about transparency. People come to ethical and responsible investing because typically they want to make a difference. They can see the financial opportunity and have their financial objectives, but often mostly also thinking about the difference that they can make in the world to address issues like climate change. So how do we convey that as ethical investors, that we are making that difference? In the climate context, we're thinking about things like communicating, the carbon intensity of the investment portfolios that our process produces compared to just a general market benchmark. Also the level of renewable investments, investment in clean technologies, that the greater investment that our approach is bringing compared to the market portfolio. But I want to get on to the issue itself, that issue of climate change and the challenge and opportunities that it creates for us as a species, but also for us as investors. And climate change is a really good way, I think, to think about ethical investing for a number of reasons. It has helped fuel the growth of ethical and responsible investing over recent years, but the breadth and complexity of climate change, including the many social and environmental issues it raises, makes it a good case study to highlight the complexity of the many aspects, many dimensions of ethical and responsible investing. And it really is charging, at the centre of the biggest risks that the world's economy faces. The World Economic Forum identifies each year the biggest social and economic risks that we face, and increasingly their annual reports are showing that those biggest risks are climate change related risks. So failure to take action to limit climate change, biodiversity loss, natural resource crises, and natural capital crises. And these aren't simply future risks, on the horizon. Warming above pre-industrial levels is already over 1 degree, and it's been rising rapidly over the last century, as that chart shows. We're already living with the effects of that warming, with more frequent and more severe storms, floods, droughts, and fires. But how do we know this? We're experiencing the effects, but how do we know what the cause is? This graph is taken from the latest climate assessment reports of the Intergovernmental Panel on Climate Change. I'll stick with the IPCC for short. And these reports are the works of hundreds of scientists who are reviewing literally tens of thousands of scientific papers and reporting what we know from those papers, as well as what we don't yet know. So the 2021 and 2022 IPCC reports, the most recent ones we have, address what we know about the causes and extent of climate change, the physical impacts of climate change on people, animals, and the environment, the economic impacts of that change, and the pathways for limiting climate change through technological shifts in our energy, in our transport, food, and building systems. So what are the physical impacts of these rising temperatures? There are many. Looking at the next chart, we're going to take rainfall as one example. Some parts of the world are going to get more rain, some will get less. Those rainfall changes will be greater with greater amounts of warming. So parts of Australia are going to be 10% wetter, parts 10% drier, and depending on the degree of warming, there will be 20 to 30% lower rainfall in some important agricultural areas, such as the West Australian wheat belt. And rainfall not only affects drought and flood risk, it also affects bushfire risk, disease risk. Higher and lower rainfall will change where and how we grow food and how we live and where and how we work. And this is just the shifts in average rainfall. With temperature increase comes greater volatility and extremes of weather. In Eastern Australia, we can expect to see lower average rainfall with higher levels of warming. But for those of us in this part of the country this summer, it's been only too clear that in particular months and particular years, we will still see extremes of rain and flooding alongside that significantly lower average rainfall. And we can expect these extremes, rain and heat and storm and fire events to become more extreme and more frequent as temperatures continue to increase. So our experience of those climate change impacts today is shifting government and companies to act more urgently, to limit the extent of warming, to decarbonise our economy more rapidly. But even without that, next slide please, Quyen, even without the strong climate policy and action, we've already seen massive low carbon innovation and investment, which has dramatically reduced the costs and accelerated the take-up of low emissions technologies. So whether that's in renewable energy, solar, PV, onshore winds, batteries, storage. And partly this is because companies and investors have seen the inevitable climate-driven shift away from high emissions energy and transport But partly it's because these are simply better, safer and cleaner technologies. So next slide, alongside the IPCC, I've mentioned another key source of climate insight is analysis from the International Energy Agency, the IEA. They reported last year on what it will take to get us to net zero emissions by 2050. That's needed to limit temperature rise to 1.5 degrees, which is the goal of the Paris Climate Agreement, global agreement between the world's governments. So under this net zero emissions 2050 scenario, there are no new coal mines, no coal mine extensions, no oil and gas exploration, and only those new oil and gas projects which are already on the books. The IEA also invested the other side of the coin. Where are the new investment opportunities to supply this new the energy gap? And their net zero scenario shows that global clean energy investment will rise from about US $1 trillion per annum to $4 trillion per annum over the current decade. They talk about an unparalleled clean energy investment boom, which lifts global economic growth. They say that this more than tripling in clean energy investment will drive an increase in global GDP of 0.5% per annum out to 2030, speeding the recovery from the COVID-19 shock. And yeah, the IEA is an interesting organisation. Governments and companies do listen to them. They've often been criticised as an establishment defender of the fossil fuel sector. So when they're painting this sort of stark transformation away from fossil fuels towards renewable, it does get people's attention. And the next slide shows us, probably not too clearly, but let me tell you what it shows us, that whilst the energy sector is crucial to decarbonisation, we will see transition and transformation right across the economy. So the latest IPCC report identifies over 40 categories of decarbonisation opportunities across the energy sector, but also across agriculture, forestry, buildings, transport, and energy efficiency technologies, which lower demand for energy and materials. So ammonia and hydrogen-powered ships, zero-emission steel produced using hydrogen from renewables, concrete in our buildings and infrastructure which absorbs carbon, and direct capture equipment which actually sucks CO2 out of the air. And supporting all these changes, there will be fundamental changes in the minerals that we extract. The IEA scenario sees annual demand for decarbonisation minerals like lithium, graphite, copper and nickel increasing by 5 times over the period 2020 to 2050. So these are the minerals which are going to be essential to re-engineering industrial processes and our transport system to allow electricity to replace other hard to decarbonise sources of energy. So in industrial processes, we won't need the gas, which is in such short supply at the moment. Increasingly, those industrial processes will be using renewable electricity. And it's not just carbon and climate, hugely important as it is. Next slide, thanks. With competing decarbonisation technologies and pathways, the winners are going to be those that, on the one hand, are able to help reduce emissions, but also help address other local and global environmental and social challenges. So challenges like the Sustainable Development Goals, you may have heard of, these SDGs, 17 goals, which have been agreed by governments globally, which identify priority areas for global action to address crucial social and environmental challenges with a 2030 target date. So alongside climate change, the SDGs include goals to secure better access to food, water and healthcare, to reduce inequalities, to support decent work and sustainable growth, to safeguard biodiversity, to promote peace, justice and strong institutions. And this chart from the IPCC reporting shows that across to the right there, the various SDGs and how some of the decarbonisation opportunities will be positively aligned with those SDGs. They'll actually help us achieve those other goals, but some of them will be negatively aligned. So, you know, as an example, developing wind turbines in the Western Sahara in Northern Africa, that's good from a climate point of view, can reduce energy emissions, but it can also infringe human rights if it's powering the unjust expropriation of resources by foreign powers from those disputed territories, or occupied territories, I should say. Electric vehicles, of course, can give us low emissions transport, but they may be manufactured by using cobalt in the batteries, mined using child labour. So these different dimensions of global need and demand actually increase the investment opportunity for companies and technologies which can positively address a number of these different dimensions of impact. So if a battery manufacturer, for example, is able to develop less resource-intensive battery technology, is able to influence better labour practices in its supply chain, yeah, it's going to prosper compared to peers who don't deliver those co-benefits. And these multiple dimensions of need and demand and impact obviously also increase the complexity for companies, but in particular for investors who often, sitting on the outside, have limited information about whether and how companies are really addressing these issues. We are seeing much greater disclosure by companies about their ESG practices and impacts, about how they may be contributing towards the achievement of the Sustainable Development Goals. But it's fair to say that, you know, this wave of new company reporting and disclosure is of variable quality. You know, we are seeing more companies talking a good climate game, but the challenge for investors is working out which companies are walking that talk. And in Australia, we've moved on from the coal wars to the gas wars. On the one hand, you know, the narrative, we're looking forward to a gas and LNG boom in Australia as gas plays an important role as a climate transition fuel. On the other hand, we've got the IEA telling us that to achieve net zero by 2050, gas investment and use needs to fall over the current decade. To further complicate the picture, we've had now, you know, recently disruption of European gas supply. This uncertainty, you know, will ultimately be resolved by markets and technology costs with we think's inevitable expanded government carbon pricing. And the next slide, please, shows some analysis by Carbon Tracker. They're looking at the cost of electricity from newly developed wind and solar compared to the marginal cost of producing electricity from existing gas generation. And across Europe and the USA, wind and solar are already cheaper. And this analysis was conducted even before the recent increase in gas prices following the Russian invasion of Ukraine. This is a sector actually where ethical and responsible investors have an important role to play to help influence companies to look beyond the short term, beyond their existing business models and existing assets and capabilities, and to put in place transition strategies so they do have a future which is aligned with decarbonisation of the economy. And we've mentioned investor engagement with AGL, but there's also engagement programs, significant investor engagement programs with other Australian oil and gas producers like Santos, Origin and Woodside, which have big new projects on the books, which we don't see as aligned with that net zero transition. Australian Ethical doesn't invest in these fossil fuel companies, but we do engage on the issue, in particular with some of the banks and insurance companies which are potentially financing these companies and their new fossil fuel projects. And, you know, like other sectors of the economy, our finance sector needs to align its banking and insurance activities with the transition to net zero. So next slide, moving on from gas, which we think faces significant climate-related risk. Hydrogen, green hydrogen produced using renewables has clear climate and geopolitical tailwinds, but how strong are those tailwinds? Hydrogen, we think, will undoubtedly play an important role in Australian and global decarbonisation, but the size of that role will depend on the different ways that we end up using hydrogen fuel. So showing different demand scenarios there, and obviously some quite different scenarios there in the outlook for hydrogen demand. The stronger scenarios are going to play out where hydrogen is adopted widely in transport, in steel making, for industrial and home heating. But the relatively lower demand scenarios are expected if we transition our infrastructure and industrial processes to use renewable electricity. So, you know, in those cases, we won't end up needing hydrogen for things like heating and transport. The next slide, just to complicate the picture further, We've got competition between different hydrogen production technologies. Hydrogen made using electrolyzers powered by renewables will be cheaper, we think, than hydrogen from fossil fuels, but this will require a big scale up in renewables and electrolyzers. We're now seeing companies and investors stepping up to fund that scale up. To be clear, there is a lot of uncertainty and complexity, and in the face of all that uncertainty and complexity, wise investors aren't going to be simply jumping to invest in anything which is hydrogen related, anything renewable, anything with a decarbonisation or a climate friendly label. Alongside the risk of company greenwash, investors need to guard against green wish. So that's the risk of overstating the financial investment prospects of sectors and projects based only on their environmental impacts. The best climate, the best investment outcomes are both going to come from rigorous impact and investment analysis of the wave of decarbonisation investment opportunities which are coming our way already and will grow. So the next slide, and actually we might flick past that one given the time. I just want to move on from the energy sector to another key sector in the climate context, the food sector. Food production contributes between about a quarter and a third of global emissions, and that food footprint will grow with population growth and with shifts to higher emissions food. As more people adopt a Western style diet, more of that includes animal protein, and that's the current trend. If the current trend continues, that's going to hugely increase the emissions footprint of our food. There are big differences in the emissions of different sources of protein and nutrition. Per gram of protein, red meat is on average about 20 times more emissions intensive than plant-based sources of protein like nuts, soy and grains. Agriculture has always been a complex sector for investors. It is now more complicated, but at the same time more interesting. Some of the challenges have been production uncertainty due to factors like weather variability and potential land degradation. Now, of course, weather variability and risk of drought and flood is increasing with climate change. But climate change is also creating opportunities for farmers, for innovation in farming practices to improve efficiency and sustainability, for generation of additional income from carbon sequestration through land and soil regeneration, planting additional trees on their properties, for adjusting land use to take advantage of increasing demand for lower emissions sources of nutrition. Shifts in the food sector raise some interesting questions about the flexibility of our consumption habits. Many of the opportunities for decarbonisation, which are most talked about, won't change the day-to-day of many of us in Australia. They will for those, in some countries, of course, those which are affected by the physical impacts and most severely, and those countries where some of these new technologies may bring people safe and reliable energy for the first time. But for most of us, at least in the near term, the impacts to our day-to-day might be limited. Green steel is still steel. Our lights are going to shine the same with renewable or fossil fuel electricity, and getting from home to work with an EV is not too much different to driving a non-electric car. So it is interesting to think about some of the other changes to our world and lives which will be more personal. Next slide. Food and diet is often a hot button topic. A nutritionally complete plant-based food powder as a replacement for our current diets isn't going to excite most people, doesn't excite me. Many people react negatively to plant-based meat and the prospect of lab-grown or cultured meat, but it is important to think about potential climate-driven changes to our day-to-day living. As well as using different building materials, we may end up building much smaller houses. As well as different cars, we may use alternative forms of transport. We may use less transport altogether. And beyond changes to our lifestyles, we may need changes to our news, our social media, to the quality of our public debate, changes to strengthen our democracies. Taken all together, these changes could translate into huge changes to our lives, our society and our economy, and to huge changes to the prospects of the different sectors, geographies and companies that we invest in, or which we choose not to invest in. I'm going to leave it leave it there. Thanks for your time.
Thank you. Yeah, I think we can actually stop sharing that.